Welcome to today's episode of Wise Tech for Wise Money. Today we will discuss the Transformational CFO, where finance and law intersect. Before we dive in, I'll give you some quick context. I'm Gary Wayne, founder of A1 Solutions. We partner with business leaders to help them navigate the evolving landscape of AI, compliance, risk management and marketing in order to scale their business. Today I'm joined by Shawn Creedon, founding partner at Convergent Consulting Group, based in New York. Shawn is both a CPA and a lawyer with a 30-year career spanning operating company leadership, private equity, distressed debt, and top-tier law firms. He's recently been as a winner of the OIBN 2025 Executive Circle Award for his remarkable leadership and commitment to excellence. We're interviewing industry leaders like Shawn to gain deeper insights into how financial and legal expertise can transform businesses, particularly in complex situations involving growth, transformation, or capital rebalancing. Thanks, Shawn, for being here. It's really good to have you here.
No, my pleasure, Gary. Thank you for having me.
Before we continue, could you give us a little bit of history about your business and what led you to pursue both CPA and law qualifications?
Sure, happy to. So I started off in undergrad as an accounting and economics student, and came out practicing at what was then one of the big eight accounting firms. My career spans long enough that the catchphrase was big eight, not big four when I started. I started at Coopers Lybrand, which became part of PwC when it merged with Pricewaterhouse. And after a handful of years doing that, was working for a partner at Grant Thornton, actually, who was both a lawyer and a CPA, and we started doing a lot of work with high net worth individuals. And this was the first illustration to me of the convergence of the two. He pointed out, look, we can do all the tax planning, but at the end of the day, the lawyer is going to be the one to write up the documents. And I sort of chafed at that hey, we can write, we know how to write, we know what the law says, right? Why do you need to be a practicing lawyer for that? But the truth is you do, right? And so you can tilt at windmills, or you can acknowledge that, hey, if you want to do this, you need this other certification. So I went back to law school thinking I would study estates and trusts and wills and that sort of thing. And this was the late 90s, early 2000s. The baby boomer generation was retiring. There's a whole slew of business owners who are going to look to transfer wealth to the next generation, and that can be how I earn a living. I got to law school and discovered there's also this thing called the front page of the Wall Street Journal and multi-billion-dollar M&A deals, and that quickly became more exciting. So I pivoted within the first week to studying that. Fortunately, I went to a very good school, so I was able to make that pivot and transition and come out and practice on Wall Street. And what I have experienced throughout my career is that the two, finance and law, intersect. They're intertwined inextricably. My first law firm, I was in the finance department, corporate finance department. So I was practicing law, but I was doing credit agreements and securities offerings. My first job after that, I got poached by a client, which was a hedge fund doing distressed lending. And they had me initially in a legal role, and then as the financial crisis took hold, pivoted me to head up their restructuring team, which I did for 5 years during the crisis. A phenomenal seat, just an incredible opportunity that I got lucky and lucked into, right? But again, it was an intersection of finance and law. It was working out financially distressed companies where, in order to do so, you need the legal underpinning of understanding the bankruptcy code and what the options are and the fallbacks and fail-safes are. And so that's been the theme throughout my career. And what I've also discovered is it's been what's made me the happiest. When I look at the roles I've enjoyed the most, they've been that role at Silverpoint Capital. They've been the role at Sundial, where I was both CFO and General Counsel of a Bain Capital portfolio company, and got to solve the problems on both sides of it. And so as I looked for what's the next step in my progression, it just made sense to do something like that. And what I learned is that increasingly companies they're not looking for the good athlete. They're looking for the siloed specialist who's done not only one of finance or law for a number of years, but in a specific industry, so that they have deep expertise in that one area. And I think that's a missed opportunity to get the value and the benefit of multiple perspectives of somebody who's worn a lot of different hats. And something that I valued in various corporate board roles, being able to hear from everybody in the room, right? I always was the guy who wanted the CFO and the general counsel and the head of marketing in the board meeting so that we can hear all the different perspectives and inform the decision with multiple diverse viewpoints. And so that's been, that was a frustration as I went into the job market to look. And what I quickly concluded is, hey, I don't need to have an employer give me both roles. I can take both roles and start my own firm. And so I've done that, and I've been able to do some clients want me for legal work, some want me for finance work, some want me for both. So it's been a great mix. It's been very rewarding.
I think that's amazing. I mean, it amazes me that they don't have a qualification out there that combines both. When they are so closely entwined.
I think there's probably a reason for that. There aren't too many people as dumb as I am who would do both. Not as many. Most who are both CPA and lawyer are tax specialists.
Right.
And very few who kind of are more corporate generalists. It's just not something that most people are not as gluttonous for punishment, I guess.
I think they're both very interesting subjects, and both need to be addressed. What major shifts are you seeing in how middle market companies approach their finance and legal functions today?
I think the first is kind of that convergence, if you will, of the two functions, where you're seeing that they used to be kind of back office silos, right? That you got to get the CFOs sign off on certain expenses above a certain threshold, or you have to get legal to weigh in on a contract before you can sign it. What you're now seeing is that CEOs want their CFO and their general counsel at the center of decision making. They want that risk mitigation mindset, because those are the two seats where the rest of the world, right? Your sales folks, your marketing, your tech, your CEO, generally speaking, especially in growth companies, they're what I call sunshine people. They're people who only see sunshine and rainbows. They only see the opportunity. They only see the upside. Generally, CFOs and general counsels, at the risk of reinforcing a stereotype my colleagues probably would shoot me for doing, we see the shadows, right? We see the risks. We see the downsides, the potentials. And so I think more and more CFOs or CEOs and leaders boards are realizing, hey, you want both, right? You don't necessarily want to steer a company by only looking at the negative, but if you're only making decisions with the positive opportunity in mind and not the downside, you're taking too much risk. And then the second is tech, obviously, right? I mean, AI has impacted everything. We're only at the infancy of that impact. It's really speed and automation, right? And what I'm seeing is more and more with clients, talking to them about things like, hey, instead of having a junior bookkeeper who's doing journal entries, every day, or for a small business, outsourcing that function to an accounting firm where they're going to charge you several $100s an hour. Once a month, they'll come in, spend a day, do your financials, and you'll get closed financials for September on October 15th. Well, and from September 1 until October 14th, you have no idea how September is going. Increasingly, as decisions get made more quickly, that doesn't work, right? Simply doesn't work. You need to have an understanding of how you're doing that's better than just kind of gut, well, I seem to be busier, I seem to be working later than I was last month. It needs to be more data-driven, more empirical, less feel. And there are ways to do that, right? There are ways to use AI to, for example, automate journal entries for routine invoices going out and bills coming in, right? So that you know how you're doing mid-month and you can make the course correction more quickly. So that you can use an automated project costing tool, for example, to know, hey, am I pricing this correctly? Is this going to be another one where I think I'm going to have a 10% margin. I'm going to wind up losing money on it because I didn't factor in X, Y, and Z, which I've missed on 2 of the last 4 opportunities as well, right? It's automating things so that not we don't have to think, but we can think more clearly about fewer items that are more critical to the business because the mundane has been kind of automated a little bit.
Yeah, I mean, it's very interesting. I mean, AI is in its infancy, and a lot of people claim they're using it, but all they're using is ChatGPT and stuff like that. There's so much more to it, and you can write coding, you can write personal programs, so there's a long way to go with a lot of different businesses. How has the role of CFO evolved over the past few years, particularly with the rise of fractional and interim CFO services?
So it's been interesting. Obviously at the large companies, the fractional model is not relevant, right? They are plenty large enough to have teams of 20, 30, 50, 100 people. In one of my roles, I managed a team of 22, and so the fractional idea was not relevant, right? Where it is relevant, though, is where you've got a small to mid-sized business. I'll call that anything under 100 million in revenue, where you may even have somebody who has that CFO title, right? But what they really are is an experienced bookkeeper, and somebody who can close the books for you, tell you how things went, tell you what the results of operations were, but they're not going to help you steer the organization. They're not going to help you identify ways to reduce risk. They're not necessarily going to be the ones who identify the best process for closing in the most efficient way possible to get reliable numbers more quickly. And so for those companies, the fractional model has really worked well and has gained traction. And the idea behind it is have somebody come in who isn't there day to day, isn't kind of burdened by the history of the organization, and the personalities involved, and can come in and objectively look at processes to see what things can be done more efficiently, what things are maybe being done, and this is often the case, too many things being done by one person because historically that person showed aptitude and is trusted by the leadership, and so they're doing 80% of something. If they did 60% of it, the other 20 could be done concurrently rather than consecutively, and so you could get things done more quickly. That's the type of thing I think is very helpful. And then the final piece is the strategic overview, right? Having somebody who can come in and look at the financials once they are done and reliably accurate and say, okay, where did we go wrong? Where did we vary, or what discrepancies do we have relative to our forecast, to our most recent forecast, or our annual budget? Should we be updating our budget? Should we be looking at our liquidity? Is our cash flow okay? Or are we going to be, facing a cash crunch 10, 12, 20, 26 weeks from now? Doing that kind of topside strategic overview, rather than just kind of, if you will, the green eye shade bean counter model of what an accountant is. Right, that's the real value, is getting somebody who's not the bean counter but is a strategic financial partner who can help you grow the business.
Those fractional CFOs, do they have, how many sort of roles do they have like that?
Typically, if you're it really depends on the type of the role. But if it's the type of role I just described, where it's strategic, I think if you're anything more than 4, you're probably stretching yourself too far, candidly. It's one of the challenges for the fractional CFO, for the executive like myself, is how do you fill your plate so that you're busy and you're earning a good living, but at the same time, don't overburden yourself because clients need your attention, right? And that's the primary goal. So what's good for me is having both of those roles, right? The legal work tends to be more steady. The finance roles tend to be more predictably peak and valley, but peak and valley nonetheless, right? So, middle of the month, if you're doing things right from kind of the 10th to the 25th of the month, you're probably a little slower on the finance side. It's month closes. It's looking at, this time of year obviously is busy with building budgets and trying to figure out forecasts for next year and plan for next year. Whereas the legal role work tends to be more, hey, you're going to have 15 contracts a week to review, need your quick, turnaround markups, comments, and summary to me back, and that kind of thing. So having both allows me to keep that balance where I don't feel like I have to take on 6 clients to fill my plate, but at the same time, I can give clients the appropriate amount of attention.
In the UK, lawyers and accountants or CPAs charge by the hour. Is that the same in the States?
Generally speaking, yes. I have some clients where I've told them, hey, look, you want predictability, so we'll kind of put brackets around things and say, I'll give you up to 10 hours a week or 20 hours a month, pardon me, whatever their needs are. For a fixed amount, and then anything after that we'll work through on an hourly basis. But generally, yeah, it's hourly, depending on the need of the client.
So how do you manage that? Because I'm not sure what it's like in the US, but in the UK, lawyers cost more than accountants.
They do, and
Is
so
that the
it's
same in
always
the
a
US?
conversation. Yeah, and it's look. I mean, it's also a lot of the profession, both professions, accounting and law. Most practitioners look at billing from their perspective. And what I mean by that is I charge $400 an hour, I charge $900 an hour. And that's what I charge. And it doesn't matter what kind of work I do, that's what I charge. I don't believe that model makes sense. I never have. Even when I was practicing in it and charging $1,000 an hour for myself through big law firms. What I believe makes sense is, well, tell me what kind of work I'm going to do, and I'll tell you what it ought to be worth to you. If you're hiring me to do bookkeeping work, which, by the way, you shouldn't, because I'm not really the right option for it, but I'll find you somebody who can do it more efficiently. But I'm not going to charge you the same dollar amount I would charge you if I were reviewing an M&A contract that is potentially transformative to your business, right? So generally, I work out payment plans that reflect the value of the work rather than the cost of my time. It just seems to make more sense to me.
That's good. Your background spans private equity, distressed debt, restructuring, top-tier law firms, etc. How do you use that experience with your in your practice?
Yeah, I think it's mostly being able to see things from multiple perspectives, right? So take a restructuring negotiation, for example. I can go in, and I have many times, and sat down and said, first you look at the financials, right? Figure out what's the objective truth. But then, okay, I'm going to meet with the C-suite team to explain to them what I found, what I think the plan is. I know going into that, their first concern is, am I still going to have a job, right? Is this guy firing me? I've been in those discussions where you're surrounded by 8 or 10 people, and they're all panicked, and they're all thinking, am I going to make my mortgage payment? Am I going to be able to make my car payment? Am I going to have to tell my wife that I'm out of a job? And so you know what to address first and how to address it. And you know to do it with objectivity and with integrity, because it's easy to tell people what they want to hear. If it turns out not to be true a month later, you have to let one person go. The other 8, if you told them all they're safe, the other 8 are going to look at you and say, okay, I can't trust you anymore, and you've lost credibility. And credibility is everything, right? So certainly having that perspective, knowing that, okay, if I'm meeting with those folks, that's what they care about. If I'm meeting with the board, they're focused on their own liability, right? Did I, as a member of the board, discharge my fiduciary duties correctly? And then they're also obviously, hopefully, concerned about the future of the business and doing the right thing. The private equity owners in a restructuring context, do they still think they're fighting for equity value? Do they still think they're in the money? Or are they ready to hand over the keys and they just want their liability release, right? The lenders, how are they thinking about it? Do they think they're going to get a full recovery? Or is there a loss of trust between the senior leadership at the company and the lending group? Vendors, right? I've been the CFO at a company where we were a vendor to a company that went through a bankruptcy. They're just thinking, am I going to get paid at all? And are you a future client, right? So it's being able to understand where are they coming from. Again, to the same point about how I bill, right? Put yourself in the other person's shoes first, and if you can do that and understand what they see, you can find a solution that gets as close as possible to being mutually agreeable. You may not be able to get all the way there, but a consensual deal is always better than a contentious one if you can get there.
Do you have a typical client?
Not really. So I do it depends on the type of work. On the legal side, it tends to be larger private equity firms and doing spillover work. So I've done work for Blackstone, for Cerberus, for a bunch of other large PE firms. And it's back office legal spillover, right? Special project where they may have a staff of 2 or of 22, but whatever their staff is, it's typically staffed for steady state level of work, not for the peak. So when they hit the peak, special compliance project, special regulatory project that they need to comply with, I can bring a team of as many as 10 paralegals plus myself. We're far more cost efficient than the big law firms where somebody with my experience is charging $2,000 an hour probably these days. And I can come in at a fraction of that, and with paralegals who are very well trained and experienced people and can come in at a fraction of a junior associate's role. On the finance side, it tends to be a little bit more predictable as well, and that is typically because it's fractional. Typically early stage, so either everything from pre-revenue in some cases to that kind of $10 to $30 million revenue business is typical, where they're, like I said, looking for. Help me figure out if I'm doing my close the right way and being as efficient as I can. B, do I have the right people in place? And C, am I using technology correctly? And then finally, help me grow the business, right? I'm facing, and usually this is how business comes in, I'm facing a strategic decision. I've got to think about investing in a new facility because the one I'm in isn't big enough. Or I want to buy out a competitor, but I don't know if I'm paying the right price. Or at the other side of it, I'm running into a cash flow problem and I'm worried about being able to make payroll over the next couple of pay cycles. What's going wrong? Because I'm still generating lots of revenue, but I no longer have cash in the bank, right? So those tend to be the finance side clients.
That seems to be a big problem with a lot of companies, doesn't it? They're turning over a lot of money, but then they run dry.
It is, and it's it's funny. There's an expression. I don't know if it's prevalent in the UK as it is here, but that 90% of new businesses fail in the first year.
Yeah, that's true.
Like a lot of expressions, there's a second part of that expression which has fallen out of common use, but is important. Which to me, at least, which is that 90% of those which fail don't necessarily fail because the business is bad. They fail because they run out of cash. And that's where the expression "cash is king" comes from, right? So it's very easy to fall into the trap of looking at profitability. Profitability does you no good if you can't make payroll. And so it's all about doing that 13-week cash flow, doing a 26-week cash flow, looking and having the experience to know what are the unusual, non-recurring, non-frequently recurring items which could derail your cash flow, right? Whether it's a big CapEx project that you're going to need to make, whether it's maintenance CapEx or expansion CapEx, right? It's the timing of cash flows can upseat a good business very quickly, and it's just something you need an experienced hat to know what to look for.
Yeah, I mean, the system seems wrong to me. But when you're a company doing well, but you don't have a great track record or a long track record, you can't raise money. And then when you don't need money, you can raise it. Everybody wants to
Yeah,
lend to the
and
people who don't need it.
that's right. And when you've got a good track record and you can raise it, often they raise too much or raise it for vanity projects or bad ideas. But yeah, no, I mean, look, at the early stage in particular, it's a problem, right? It's a flaw in the market, no question about it. VC is in theory, venture funds fill that gap, but they don't really, because venture funds, because of the way they're structured, right, and what their investment thesis is. Their investment thesis is relatively little diligence, move quickly, invest in lots of companies. If you invest in 10 and 6 of them wind up as 0, 2 of them are singles or doubles, and one or two are home runs, and one's a grand slam, to torture the baseball analogy a little bit. If there were a better soccer analogy, I would have tortured that instead, Gary. My apologies. What they're always looking for is the grand slam, right? They're always looking for the 100x investment, because it makes up for all the 0x's they get on other investments. And the problem with that is, what that disproportionately means is they're chasing tech deals, because tech deals are things where you can scale with almost no marginal cost, right? Once you build your MVP, you fine tune it into your finished product, then it's all about getting market traction. There is no incremental cost to deploying the software yet one more time. That's great, but it leaves services business, for example, completely out in the cold when it comes to startup capital raising. And so there is a gap. It's a flaw. It's something that I wish I had the magic ball magic wand to wave to solve the problem. I'd make myself very wealthy in the process, but not one I have a fix for. But certainly, you're right. It is an issue.
You mentioned you served in C-suites, on boards of directors, in lender investment committees. What insights do those roles do to help you on your consulting work?
Again, I think it's perspective. Yeah, I think having the awareness of what each stakeholder in a discussion wants, or what they expect, what they need, enables you not only to plan for discussions, but also anticipate requests, and be able to manage around things when you see minefields come up. It also just gives you a better sense of the possible, right? So if I had been just, quote unquote, just a CPA for the last 30 years, I would have no idea about the regulatory risk from, FDA, FTC, you name the alphabet soup, right? The legal regulatory risk would not be a prevalent concern of mine. If I had never served on a board, I wouldn't have exposure to things like sales strategy, go-to-market strategy, right? Finding the right and knowing how to evaluate and find the right head of operations. Those are all things that, had I never served on a large corporate board, I would have no idea, how to do that. So it's learning best-in-class practices for a variety of things you would otherwise never see. I've seen best in class how to hire people, right? How to build a marketing team from scratch. Those are things that, if you haven't served in multiple roles, you just never get exposed to.
Where do you see the biggest opportunities for companies in the next 3 to 5 years, particularly those looking to scale or take on private equity partners?
So, interesting question. I think from the standpoint of companies looking to scale over the next 3 to 5 years, you're largely, I'll bifurcate that into 2 buckets, tech and non-tech. Because I think there's obviously, with all the businesses that have spawned over the last few years focused on using AI, as the next 3 to 5 years evolve, those businesses will mature. Many of them won't make it. The ones which do will probably make it tremendously successfully. And then there's the non-tech piece, which is equally important. On the tech side, I think you'll see 70-80% of these AI-driven startups will fail, right? That's just unfortunate, but it's reality. There will be a handful of big winners in each industry. The ones which there'll also be a handful in each industry of AI-driven tech products which start to succeed and then implode on themselves. And it won't be because they don't have the best tech. It'll be because they didn't manage their finances correctly, or they didn't have the right go-to-market, or they had infighting among their executive team, all things which can be managed around. Unfortunately, what I've also seen in tech is oftentimes the folks who founded the business and are making the decisions are tech people, which makes sense. But they're not necessarily trained in how to be great leaders. And so oftentimes what you see is that the tech companies that are tremendously successful happened to have people who were great leaders at their helm, but they got lucky. And so I think one of the things that will inform how many of these tech startups which gain initial traction are able to get to that next level of being successful and then mega successful, don't rely on getting lucky, right? Rely on best processes. So if you're starting to see that traction and you can afford to invest even a tiny little bit in leadership training, go get it, right? Or hire somebody who can wear multiple hats for you, right? Somebody who's done that leadership training as I have, who can say, okay, let's look at the personalities involved, figure out where there's friction points, and let's solve them early. Not necessarily everybody's going to get along and we're going to sing Kumbaya and take warm showers together until 3 in the morning, right? As to quote Clint Eastwood. But to make sure that we can functionally make decisions together that affect the business without rancor, without hostility, and without sharp elbows, protecting our own turf. On the non-tech side of it, I think it's less, if you will, cataclysmic or transformative kind of cliff decisions, right? Falling off a cliff decisions, because there isn't an AI-driven boom there, at least not as an acute boom. On that side, I think you'll see the rise of fractional. I do think you'll see people, and I think it expands. I've talked to and partner with fractional CMOs, fractional sales leaders, CROs. I think you'll see a rise in that model. I think the idea of getting somebody 20, 30, 40% of the time with 100% of the experience for 50% of the cost is a model that works for both sides, right? The executive, somebody like myself can maybe cobble together 3 clients like that and make a nice living for themselves. But more importantly, the client is getting someone who has 30 years of experience across a multitude of roles for half of what it would cost to get a full-time CFO, right? And they're getting what they need. They don't need 40 hours a week, 50 hours a week. They need 20 hours a week. And they'll get that, and it'll help transform their business. And if you're doing it right, the bottom line should grow as a result of that investment in a fractional executive. It should not wind up being an expense item.
It actually makes sense because the fractional CFO or whatever role he plays, actually, if he's dealing with 4 or 5 companies, he's getting a lot of experience, a lot of exposure. He isn't polarised. So he's actually really on the ball compared to the guy that's actually entrenched in one role. Because you're seeing how other companies are operating at the same time. So you're using a wealth of experience, all current, in the roles you play.
Yeah, I think that's right. I think, what I've seen, and again, this goes back to kind of the origin story of Convergent for me. Increasingly, companies, I think, are getting that wrong. They're looking for, I talk to people about roles at beauty companies, for example, skincare companies, and they said, "Hey, we love that you were both CFO and General Counsel at a hair and skincare company that got sold to Unilever for more than $1 billion. Terrific, wonderful story. But you haven't been a controller and then FP&A and then CFO at 3 different beauty companies. You've only done it at one." Well, true. But I have served on a board, and I have multiple boards, and I have served as the internal lawyer for a team, and I have served, but we have a lawyer already. Fine, I'm not looking to replace that role, but aren't you better off if you have in that C-suite, in that CFO seat, someone who has multiple perspectives, right? So that you don't only have to think to yourself, how many times does it come up that there's an issue a lawyer should know about, but the lawyer wasn't invited because nobody figured the conversation was going to have a legal element to it. And that's the biggest risk and the biggest fear for any in-house lawyer, is that decisions with legal implications are being made with them not in the room and not knowing about it. It happens all the time. And so why wouldn't you want someone with both backgrounds in that C-suite, which typically lawyers are not in the C-suite, which I think is also a mistake, but that's of course self-serving as a lawyer. But it only makes sense to me that if you can hire great athletes rather than specialists, you're getting multiple perspectives in different roles.
Yeah, I agree. You've helped founders through transformational transactions. What excites you the most about guiding companies through growth phases or potential exits?
The opportunity and making sure they don't miss it, right? I mean, I think so many times you see growing companies where they grow because their CEO or their key leadership team, 2 or 3 people, know the customer very well, right? Whether that's an HVAC company or a hair care company or a tech company, they know their customer very well, and they know how to market to their customer. They know how to build the product their customer is going to want. But what they don't know is how to lead an organization. They don't know how to build processes and procedures. They don't know how to build risk safeguards. They don't know how to build processes around financial controls, right? So they get people stealing from them, things like that. And so being able to come in, look, I am nobody's innovator, right? I am not the guy who can come up with the next great mousetrap. It's not what I do. But what I can do is say, hey, great idea. I love what you're doing. Here are 5 ways you can make it just a little bit better. And those 5 ways are not going to be necessarily earth-shattering ideas, but if each of them adds 5 or 10% to your bottom line EBITDA, you could take a $10 million EBITDA business and turn it into 16. And if it's in the right industry, you might have added $50 or $60 million in value by making 5 or 6 relatively small tweaks that can improve the value of the business. So that's what excites me the most is that opportunity when it's not so large that the processes are already built to really impact an organization.
You mentioned you bring business first focus to legal matters. How does that differ from traditional legal advice?
Well, that's a great question, Gary, and it goes back, in my view, to how we're trained in law school. And it's rarely explicit, but as a lawyer, you're trained never to be wrong, right? You'd rather make 5 decisions a day and make sure all 5 are correct than to try to make 10 and maybe one of them is going to be wrong. And that's probably many who go to law school come with that mindset already. But certainly by the time you're out of law school, by the time you've practiced for 3 or 4 years, that is ingrained in you. Don't be wrong, right? Rather say nothing than say the wrong thing. And that makes sense to a point. But that makes sense when you're outside counsel, I think, and you're asked for advice on key strategic, potentially transformative questions, right? Issues. It doesn't make sense when you're in-house making decisions every day, making a dozen or 100 decisions every day to impact the business. You need to be quick, you need to be decisive, you need to be comfortable making decisions with less than full information, because that's just the way business operates, right? It is not a legal exercise, it's not a case study. And so I think that's been the biggest thing to me, is you have to get comfortable with that pace and that decision making.
Fantastic. What approaches have worked best for you, helping companies control the narrative during in-court processes or crisis situations?
So I have managed companies through a couple of crises. Hired a crisis management company in one case, and one case kind of did it myself. It was a fascinating experience. It's terrifying because it's a crisis. In that case, in the first case of our own making, and you're trying to figure out how to minimize the damage. What I learned is, in some ways, that crisis management is how well that goes will have already been determined by the time the crisis takes place. Everybody makes mistakes. Every company has people who were hired for the wrong role, or were given too much freedom too quickly, or they lost trust in the organization, and so they started doing things they shouldn't have done. But how well the organization responds to that is informed largely by how much trust the team has in leadership. If the rank and file team members believe in leadership, and most importantly believe leadership has their best interests at heart, within the context of a business, right? Everyone still understands the business is trying to make a profit, and we're not going to give away money and bonuses and all that sort of thing. But if you believe that your leaders have your best interests at heart, you'll be willing to swallow what could otherwise potentially be harder advice to swallow in the context of a crisis. And so a real world example of that, I had a company where there was a social media uprising or storm about an ad we released. And it caused certain members of the team to be targeted on social media for doxing and for being called some pretty horrible things, and truly offensive name calling and things like that. Our leadership had earned the trust of its people over the years. And so when I went in and said, hey, look, the right strategy is don't add fuel to the fire. Don't start attacking those people who are attacking us and pointing out how horrible and bigoted and discriminatory their comments are. It's only going to add fuel to the fire. The way a fire dies is you deprive it of oxygen. So we've said what we said about the ad itself. We're not going to respond any further. Let it die out. It's going to feel like we've abandoned the employees who are being targeted, right? But we're not. What we're trying to do is protect you in the long term by ignoring this in the short term. Fortunately, with only one exception, the company had enough trust engendered and built up over the years that every employee except one was willing to live with that. One employee had personality conflicts with the company in the past over other things, and then was targeted as part of this problem. She was not able to get over it. And so I saw very clearly what that line of demarcation was. Do you go into the situation with that level of trust already established? If you don't, the tension of being in crisis is probably going to be a breaking point. But if you do, generally you'll come out the other side of it in a couple of months. And these things are shorter lived than people think. When you're in the middle of it, you think this is never going to end.
Sure.
Typically 6 to 8 weeks is the life cycle, if that. I think it's gotten even shorter now. Most people in the States have probably already forgotten there was a government shutdown and it only resolved a week ago. So,
True.
I think it's patience, it's having trust. It's unfortunately by the time it happens, you're probably your die's been cast a little bit. But there are still things you can do to make it either better or worse, depending.
For funds and private equity firms, what are the most common legal and compliance blind spots you encounter?
For the PE funds themselves?
Yeah, generally.
So, that's a fascinating question. They have some of the best legal advice available in the world, right? The larger firms have, former partners at AmLaw 10 funds or firms as their general counsels. they have staffs of anywhere from 10 to 50 or 75 or 100 lawyers. And they're all very, very qualified, very experienced, well-educated people. They do still have blind spots, right? I think it's there's such a volume of regulatory responsibility for any company in the U.S., but especially any registered investment advisor. And I think where they get into trouble is not realizing they have obligations on certain things. I think once it's on their radar, it's fairly easy. They're diligent, hardworking people. They track things well, and they'll figure out what the law is. They'll comply with it, and they'll put a process in place to ensure future compliance. It's the things they don't know about. For example, and I'll take a hypothetical example. Private equity firms set up funds, right? And so they'll set up a fund to invest in, let's say, infrastructure assets in the MENA region, just as an example. And they'll have 100 limited partners come in as investors to fund capital, to provide capital commitments, which then they draw down to make their investments, right? That's the typical model. Well, if you've got 100 investors, you've got a partnership agreement that sets forth the obligations the partnership has toward those investors. But a lot of times those investors will have specific, unique to them requests. So it may be restricted investments, things that I don't want you to invest in. So, no oil and gas, or no weapons manufacturers, or, no illegal drugs, things like that. It may be special reporting requirements if they're subject to specific reporting obligations based on European regulatory requirements. A variety of things. It may be that they get special economics because they're contributing so much capital or committing so much capital that they get a reduction in the carry or the management fee. And so rather than put that into the partnership agreement and make it available then to every partner, you create a separate side letter. Well, if you've got a separate side letter agreement with each LP, you've got 100 of them, and each of them may have, believe it or not, 60, 70, 80 obligations in them. So you may be looking at 8,000 obligations in 100 different documents. How do I track all that? How do I keep track of it? Well, until relatively recently, that was done, believe it or not, by Excel. And just kind of creating columns for, do I have an obligation to report, an environmental issue? Do I have an obligation to report a legal issue, a litigation matter? And there'd be yeses or nos next to the corresponding LP in that fund. Incredibly inefficient. Doesn't allow for reminders and ticklers and that kind of thing. And so that's been something that I worked for several years to set up awareness and to solve that problem for private equity funds using an AI-driven tool. I think it's things like that. It's a long answer to a short question. I apologize for going into more detail.
If you could change one thing with how companies approach their financial and legal strategy, what would it be?
More integration. I think that a lot of lawyers resist the idea that they would report into a CFO, and I think it's more a reaction to, well, finance isn't more important than legal. Why should I be reporting in if we're heading up our different functions? I don't care about that so much. There was a time in my career I did, and I was very ego-driven. I will admit that, but I'm in my mid-50s now. I think I'm past that. It's more about getting to the right answer and getting the right process in place to get to the right answer. And for me, that means legal and finance should both be in the discussion. So for me, I think it's integrating the two, and by integrating them, elevating them, right? A lot of organizations are now realizing that the CFO is a legitimate member of the C-suite and should be in on key decisions, key strategic decisions of the company. They haven't yet gotten there with their lawyer. And I think part of that is, you asked a little bit earlier about kind of, the benefit of how do you get to be kind of a commercial lawyer, right? I think part of the reason the lawyer hasn't been elevated to that role of being a key strategic decision-making partner is because too many lawyers aren't business-first lawyers. They are I started going down this path, and I probably sidetracked myself. They are what I call no lawyers, right? Lawyers who are have adopted that mindset of never make the wrong decision, never be wrong, right? Rather make 5 right decisions than 100 right decisions and 1 wrong one. And as a result, they never want to take risk, because if you don't take risk, you can't get burned. And so when faced with a potential business transaction or business strategy or anything as simple as a product label change, they'll just look and say, no, don't do it that way. There's risk. Well, there is risk. There's risk in everything. There's risk in crossing the street. But there are risks worth taking and there are risks not worth taking. And how do you quantify that? Too many lawyers are afraid of numbers, so they're not willing to say, well, there's an X% chance risk that this happens. If it does, here's the likely financial impact to the organization or reputational impact. And as a result, if I probability weight that impact versus what do we think the benefit is, well, here's the benefit in potentially gained sales or in reduced costs and whatnot, and then cost benefit analyze that, right? Too many lawyers are either afraid of numbers, think their job is to ensure zero risk, or just simply don't want to take that personal risk that if it goes wrong, they'll get fired, right? And so I think it requires the melding of those two functions so that you can identify the legal risk, quantify it, probability weight it, quantify the upside to taking the risk. If the downside doesn't pan out, what are we gaining out of this? And then make that cost benefit analysis in a logical way. Unfortunately, in many organizations, that means the CFO and the GC have to work together because they aren't the same person, or because one of them isn't qualified in the other area. It's one of the things they like to think I bring to the table, that I can do both. But I think either way, it's critical, because how do you make informed risk-taking decisions unless you A, know what the risk is, B, know what the probability weighting and the impact of that risk is, and C, know how to quantify the upside as well.
Makes sense, and that's why everyone needs Convergent Consulting.
I'd like to think so.
Well, Shawn, that's been a fantastic podcast. I've learned a lot, and I'm sure the listeners that listen to this will as well. For people out there that need your services, where can they get hold of you?
So convergentconsultingny.com is the website. I'm on LinkedIn as well. And, my contact information is there. Feel free to reach out. I have a button, a Calendly button to set up a free consultation. I offer the first half hour free to see if I can help, give you a few ideas, and learn the business a little bit so that we can see if there was a partnership makes sense.
Fantastic. Well, everybody, thank you for listening in. Shawn, thank you for joining us. I'm Gary Wayne. You can contact me on LinkedIn as well, or at Gary@A1solutionsinternational.com. Thank you very much for listening in. Shawn, once again, thanks again.
Thank you, Gary.